How to Properly Structure Your Malaysian Business, the complete guide. If you're running a business in Malaysia and you've never sat down to properly structure it, this video could save you everything. I'm not going to waste your time with theories. Everything I'm sharing today comes from real experience structuring multiple companies across different industries in Malaysia. By the end of this video, you'll understand exactly what separates businesses that survive from businesses that collapse. Let's get into it. Chapter 1, Holding Company. Let's start with the holding company. Most Malaysian entrepreneurs run everything under one Sendirian Berhad, one company, everything inside it. All the risks, all the liabilities, all the assets in one place. That works fine until something goes wrong. One lawsuit, one failed project, one bad partner, and everything you build is exposed. A holding company separates your businesses. Each operating company runs independently. The Holdco sits above and owns shares in all of them. Now, here's what most people don't understand. It's not just about protection. A proper Holdco structure also makes it easier to bring in investors into one company without affecting the other. It makes it easier to sell one business while keeping the rest, and it makes succession planning significantly clearer. The question is not whether you need a whole co. If you're running more than one business, you do. The question is how to structure it correctly for your specific situation, and that depends on your industry, your partners, your revenue, and your long term goals. This is where detail matters, and details are different from every business. Chapter 2, Shareholder Agreement. Now let's talk about the document most Malaysian business partners never have until it's too late. The Shareholder Agreement. I've seen partnerships of 10, 15, even 20 years fall apart because there were no shareholder agreement, not because the partners were bad people, but because nobody defined the rules up front. What does a shareholder agreement actually cover? At minimum, how decisions are made, how profits are divided, what happens when someone wants to exit, and what happens when a shareholder passes away. But a well drafted shareholder agreement goes much further than that. It covers deadlock situations. What happens when two equal shareholders completely disagree and neither will budge? It covers drag along and tag along rights, protecting minority shareholders while also giving majority shareholders the ability to close the deal. It covers anti-dilution clauses, protecting your percentage when new shares are issued. Most Malaysian SMEs sign the basic SSM form and think they are protected. They are not. The difference between a basic shareholder agreement and a properly structured one could mean the difference between keeping your company and losing it. Chapter 3, Paying Yourself Legally. This is the question I get most often. How do I pay myself from my own company without getting into trouble with LHDN? There are three legal methods: director's salary, director's fee, and dividends. I covered the basics in a short video on this channel, but here's what most people don't know. The combination of these three methods that works best for you depends on multiple factors: your company's profitability, your personal tax bracket, your EPF contribution preference, whether you have other income sources, and what your auditor and accountant recommend basis on your specific financial year. Some directors are better taking a lower salary and higher dividends. Others are better structured with higher fees and minimal dividends. There is no one size fits all answer. What I will tell you, the worst thing you can do is take money out of your company without documentation. No board resolutions, no proper declaration, just transferring money to your personal account and hoping nobody notices. LHDN notices. your auditor notices. And by the time they raise a flag, the penalties are significantly more painful than getting it right from the start. Chapter 4, Director's Loan. Speaking of taking money out incorrectly, let's talk about director's loans. A director's loan in itself is not illegal. It is a legitimate financial tool when used correctly. The problem is most Malaysian directors use it incorrectly. They treat their company account like a personal ATM. Money goes in, money comes out. No documentation, no repayment plan, no board resolution. Here's what happens when that catches up with you. Your auditor flags it in the financial statements. LHDN investigates and reclassifies it as income, meaning you now owe tax on money you thought was a loan. And if the company ever faces liquidation, the liquidator has the legal right to pursue you personally for every single ringgit. I've seen directors face personal bankruptcy because of undocumented director's loan, not because they were dishonest, but because nobody told them the rules. A properly structured director's loan has a board resolution, a loan agreement with terms, an interest rate, and a repayment schedule. Your company secretary prepares it, your auditor reviews it, and it gets repaid on time. The details of how to structure this correctly for your situation depends on your company's financial position, your existing liabilities, and your relationship with your auditor and bank. Chapter 5, Paid Up Capital. Let's talk about something that costs almost nothing to fix but holds thousands of Malaysian companies back every single year. Paid up capital. Most people register their Sendirian Berhad with RM1 or RM2 paid up capital because that's the minimum and nobody tells them otherwise. Then they wonder why the bank won't give them the proper business loan, why they can't qualify for certain government tenders, why investors don't take them seriously. Your paid up capital is a signal. It tells everyone who looks at your company how much the shareholder believes in, enough to actually put money in. RM1 says nobody believes in this enough to invest even a single ringgit properly. Increasing your paid up capital is not complicated, but it needs to be done correctly through a proper allotment of shares, a board resolution, filling with SSM, and updating your shares certificates and statutory registration. The amount you should increase to depends on your industry, your business plans, what loans you're targeting, and what tenders or contracts you want to qualify for. There's no magic number, it's specific to your situation. Chapter 6, Company Secretary. The last thing I want to cover today is the person most Malaysian directors treat as admin support, but who is actually one of the most important people in your company's secretary. Under the Companies Act 2016, every Sdn Berhad must have a licensed company secretary. This is not optional, it is a legal requirement. But beyond compliance, a good company secretary is your early warning system. They tell you when filings are due, they prepare your board resolutions correctly, they maintain your statutory registers. They flag when something you're about to do could create a legal problem. A bad company secretary, or worse, no company secretary, means missed deadlines, unprepared documents, invalid decisions, and a company that looks disorganized to anyone does due diligence on you. When you're raising funds, banks and investors will look at your corporate documents. If they're a mess, it raises red flags about how you run your business. Choosing the right company secretary, understanding what they should be doing for you, and making sure they're actually doing it. That's something a lot of business owners get wrong and only realize it when it's too late. So, there you have it, six of the most critical areas of Malaysian business structure: holding companies, shareholder agreements, paying yourself legally, directors' loans, paid up capital, and your company secretary. I've given you enough to understand what each of these is and why it matters. But I want to be honest with you. The details of how to implement any of this correctly for your specific business, your specific partners, your specific financial situation, that's where it gets complex. And getting it wrong is expensive. If you want to sit down and talk through your specific situation, whether it's setting up your whole core properly, restructuring your shareholder agreement, or just understanding what your company secretary should actually be doing, reach out to us directly. We work with Malaysian businesses owner one on one. We help you structure things correctly from the start or fix what's already broken. You can contact us via our email, which is available in the description below. Subscribe to Boardroom Malaysia for more content, where we go deeper into operations, SFSM compliance, board resolutions, joint ventures, and exit planning. Real business, real strategy, real Malaysia. Thank you.